Hi all. So 2020 has been a year of complete shutdown, economic lockdown. Most of the companies are not functioning fully, and the earnings are going to be really depressed in the next couple of quarters, at least the foreseeable future. And there are many people who are invested, who are especially belong to the retired community and middle-aged community, who are dependent wholly on the dividend income from their stock investments. But when companies like big ones like Boeing are on the verge of bankruptcy or in the verge of closing down, there are many firms, even the energy sectors, large firms like Exxon, are not even fully operational, are going through a significant inventory loss and economic downturn. So in such kind of situations, how do people, who are especially depend on dividend income, how can they choose stocks, especially for this 2020 year of 2020 and maybe 2021, when earnings of most of the companies, 95% of companies globally, are going to be depressed. So I thought, I'll bring up five illustrative stocks which can have a tailwind rather during such turbulent times, and the earnings might not be as depressed or disturbed, and in fact, it will be even better in the next 1 or 2 years. And they are already having good history of dividend payouts. So I went and analyzed five firms which will be having good earnings potential in the next 2 years and has a good dividend history, and which are large companies, blue chip companies, which somebody can hold in their portfolio, especially looking only at dividend history. One who is looking at dividend income, they can look at these five illustrative examples and choose accordingly similar stocks which might be beneficial in the next 2 years for a steady stream of dividend income. Let us get into that. So here are such five stocks, for example, that has a decent dividend yield history and might still keep up with the earnings over such turbulent times. So below list is only illustrative and can on an average return at least 3% in dividend income yield for your portfolio. And trust me, 3% during these kind of turbulent recessionary period is really an amazing, outstanding returns, and would be a good aid for somebody who's dependent on the dividend income. So five firms I put in here are belonging primarily to the consumer segment, because that is the area which might be least perturbed by these gyrations and economic downturn. So let's look at the first one, Lorex, which is a firm that has been benefited with the stock up. There's been a huge pileup of upstocking by most of the consumers due to the scare of fear of lockdown, and led to scarcity and inventory run out, and they have now hugely piled up, on the demand. So the whole virus lockdown has kind of are going to kind of aid their earnings potential, and hence you can expect a similar dividend payout, just like on an average what they've been paying over the years. So in this case, Clorix has 2.2 percentage average dividend returns yield. And then so that is one firm. It's manufacturing of consumer goods. The second one is 3M, which is got a combination of consumer goods and a lot of health related products, and disinfectants and many other products like that. Very old firm, it's a blue chip company, steady firm, and is expected to fare better in their revenues, and has an average payout of 4% on historically. So anecdotally, it looks positive in terms of what they're going to return in the next 1 or 2 years. They might keep up with their dividend yields, which is a positive sign. So that is the second firm that I had to show here. The next firm is Campbell Soup. Campbell Soup is another firm that has got a lot of consumer confectionery products and food products. It has been again another firm whose products has been stocked up and piled up by consumers during the lockdown period, and they have benefited immensely with the huge uptick in the revenues and sales. So we can expect a good earnings season for Campbell products, and over the next 1 2 years, and they might have a good dividend payout. Now on an average they pay out to 2.7% and might keep up with that or even could be more, because these are the firms I've chosen which have high returns on invested capital. They don't need too much money to redeploy to keep up with their earnings. They don't have much growth. I mean, these are very slow growing potential companies, but once their earnings are good, they just return immensely to the shareholders. So the plowing back of capital back to the business is not too much for these kind of fast moving consumer goods. So so they have a dividend payout of 2.7 percentage. So that's a third firm one can look at. Then there is Target, which, I mean, pretty much all the retailers are doing good who has the online delivery capability, or who has tied up with online capability, delivery capability. And Amazon and Walmart has been doing tremendously well to capitalize on the opportunity by doing online delivery across the different states in US. And so even Target has kept up very well. Target sales has been seen a lot of uptick this year. I think the digital commerce has grown by a whopping 275%. So they have tied up with some firm called Shipit, who's gonna deliver online. And again, Target has been growing well. This is one of the odd case where one of the e-commerce is growing pretty strong along with Amazon and Walmart. And they have a good dividend payout history. They are of averaging 2.5 percentage. Might keep up with that this year and next year. Then we have Verizon, whose internet and mobile phone services are only going to spike due to the lockdown scenarios, and has a great history of high dividend payouts in the range of 4.2%. That's a significant value for the money in terms of dividends. So if you put together these five stocks in a portfolio, for example, you might end up having an average payout of 3%, which is not bad for a scenario like this. When you have if you have even one energy company in your portfolio which is high dividend paying, they might not pay any dividends this year, so that might bring down your have a drawdown effect on your dividend income for the portfolio. But then at the same time, not only these fast moving consumer companies, one can also look at some of the pharmaceutical companies and biotechnology firms like Gilead's and the Moderna. And all of these firms are also they have a good decent history of dividend payouts, and they are going to do well in this kind of season. And one can look at on the pharmaceutical industries as well. So there are different other businesses like in the software sector, but they're not huge dividend payouts. I mean, they don't have a history of high payouts. So you might end up getting 1% or something like for Apple kind of companies, but that's not high to keep up. So I thought, I'll do this exercise to show what kind of portfolio one can construct in 2020 for getting good dividend payouts. Hope this was helpful. Thanks for staying with me.